Good morning, everybody, and welcome back to Schwab Coaching for the Monday edition of Trader Talk in today's market. I'm your host, Kevin Horner. It is a chilly day here in Denver, Colorado. Pleased this morning to be joined by my friend and Schwab Regional Investment Strategist, Michael Urizzo. Hey, Mike, good to see you, buddy. Been a little bit since we reconvened there in Miami, but how you doing?
I'm doing really, really well. Yeah, exactly right. It's been a couple of weeks, but I had the privilege of spending some time with our colleagues over the weekend here in the Orlando market for a similar event, for one of our workshop events. So I got to see some of our colleagues, but I definitely miss seeing you there.
Yeah, absolutely. Not to worry, I'll be back. Plenty more to get to. We've got a lot of events coming in 2025, and so that means a lot of coaches supporting said events. So we will be out among the people this coming year. Looking forward to that. This morning, we are pleased to be joined by Cameron May in the chat. So say hi to Cam if you don't mind, everybody. He's going to get to questions and comments that Mike and I are unable to get to, but we, of course, will keep an eye on the chat nonetheless and try to get your questions brought into the discussion where we can. So please feel free to post in there for the duration of our show. We do go about 45 minutes in total. Now, before we get started today, I do want to kick things off with our disclosures, and then we're going to get into some announcement detail real quick. So briefly, just remember that our conversation here is exclusively for your information and education. Remember, we do not make recommendations here, so any expression of opinion is considered subject to change without notice. We do, however, talk frequently about technical analysis. We discuss concepts and strategies traders may choose to employ in their own processes. We want to remind you, though, that technical analysis is merely just one piece of the overall puzzle. We encourage you to think of it as such. Don't make decisions exclusively based off technicals. Beyond that, we'll remind you, of course, that we work in a paper money version of the desktop Thinkorswim application. So just keep in mind that what you see here may not be live data per se. Make sure you're working in your live accounts when you're making your decisions. As far as our agenda is concerned, everybody, we start broadly. We hit up the major indices, try to get an idea as to where money might be moving around on a short-term basis. I say short-term. We talk here daily, of course, so that means short-term on day-to-day time frames pretty consistently. Then we also look at the industry groups, sectors that are moving around, maybe some stocks in the news today as well. So that's what our plan of attack is here today. But before we kick it off, I want to remind you about a conversation we got coming for you tomorrow here on the YouTube coaching channel. If you come to our homepage here, schwab.com/coaching, and you come to the live webcast virtual workshops, we've got tomorrow, the 10th, our 2025 market outlook. It's our coaching special. If you click that link, you'll be hearing from our analysts, our Schwab Center for Financial Research analyst team here. So you'll be hearing from Kathy Jones and Jeffrey Kleintop and Kevin Gordon, who will be stepping in for Liz Ann here. But Kevin is fantastic, by the way. If you're watching and listening to what Liz Ann has to say, you're often hearing from Kevin Gordon as well. He's wonderful in these conversations. And I think this is going to be a discussion that is a great way to kind of tee up expectations for 2025. So really encourage you to make sure this is on your list for tomorrow, everybody. And with that, Mike, let's get down to business. We had our 57th new high on the SPX this last Friday, and doesn't show any real signs of stopping here. Our process has been one of grinding higher. What is it you're taking away from the grind as we get to the close of 2024?
Yeah, I mean, I think you kind of pointed it out, right? You just kind of answered your own question in my mind, right? We're getting to the close of 2024. It's been a very, very positive year overall for markets, right? I think in this stress point, there's overall, because there's always surface cracks. There's always something that's moving, where there's always an underbelly, so to say, of a market that maybe is starting to move. So I think as we're closing in on that, we expect the things that have been moving very, very positively to continue, right? We call it a little bit of window dressing in the trader world. At the end of the year, where we want to make sure our positive positions stay very positive, and maybe we'll add a little bit of to those positions, taking advantage of maybe the momentum in the market, kind of more like a trader versus an investor, right? And that's where I think there's sometimes a little correlation between I can be a little bit of a trader sometimes in the marketplace while I'm still being an investor, and vice versa as I see opportunities. So to me, I'm just looking for opportunities, aberrations in the next few weeks, but this seems pretty lock in step of what we should expect, I think, at closing out the year, so to say.
Yeah, I think traders would largely agree with that assessment, Mike. The question then becomes, are traders sitting on their right on the balls of their feet right now, though? I mean, we are here. It is the 9th. That gives us 21 days remaining in the month, calendar days. That is obviously a few of those are going to be eliminated due to holiday details. But is the feeling just that we're all kind of approaching the end of 2024 and waiting for something to change? Because that's kind of the there's this underlying aura, if you will, as it relates to the market that says, yeah, 2024 has been great. Expectations for the close are great. And yet everything feels like it could shift on a dime when we begin 2025. What are you hearing from traders with whom you speak consistently?
Yeah, so I think again, something you said there hit my brain really, really quick, right? Are traders on the balls of their feet? Well, if you're a trader and you're on the balls of your feet, you're already at a giant disadvantage, right? Because you're always up on your toes, you're always agile, you have that athletic kind of position or mindset to a market. So I think it's always looking forward to taking kind of advantage of some of these market moves where your positions are positive, right? And like I said, maybe adding to them, but maybe it's also trimming them because where maybe you want to start thinking about moving some money next year if this happens, if that happens, or else, right? So we start to think very logical about next year and start to maybe take the advantage in our portfolio where we can and be honest with ourselves and be very introspective as a trader and say, these are things that are just not working. So I shouldn't expect them to work. So let me take some risk off here because I have some better opportunity somewhere else. And sometimes, we talk about that opportunity cost. So that's what I'm looking for, I think, right now as a trader.
Yeah, that makes sense. I mean, there's likely been many trader who says this has been a wonderful year. Why would I start to position myself aggressively in the final 2 to 3 weeks of the year when I've already got good returns? I want to make sure that I manage those positive returns and I don't give back profits. So maybe this is that window of time where traders are tightening the purse strings a little bit, raising stop orders, getting a little, not defensive, but just process focused. As we often discuss in this class, Mike, the importance of having that plan and knowing how you want to go forward. Just reminding ourselves, of course, that on a year-to-year basis, things shift kind of quickly as we start to make have new expectations of what can occur. And in this case, new expectations with a new regime that'll be in charge come mid to end of January. So plenty for consideration. One thing that you and I covered briefly in our pre-show discussion was a look at the equal weighted version of the S&P 500. And I wanted to bring this up, a comparison chart of the two here, everybody. So this is the SPX. I'm going to put up the SPX EW, the equal weight. And then down below, what you see here is the SPX itself. So we just saw the S&P 500 moving to new highs, flattening out, tightening our range. Not a real surprise. But Mike, what is notable is that while the S&P 500 itself made new highs, the equal weighted version of it made a retreat to the 20-day moving average, seems to be bouncing at this point today. What do you take away from this?
Yeah, absolutely. You threw the chart up on the screen when we were talking, like you mentioned in the pre-show, and it kind of just hit my brain a little bit, right? The same way. You see that it's kind of consolidating, or it's trying to consolidate, even though the momentum is higher. It's kind of touching the short-term moving average. So you see that kind of in the SPX, you see that in the overall index. So what we were saying is that doesn't really mean anything to me yet. It's just something I noticed immediately in the pattern that gives me more questions to start to ask. So, we didn't get a chance to really unpack it, and I don't think we're having the ability to really get too deep into the weeds with it here. But I think it's just something that, makes me want to continue to look at these two stocks side by side, or maybe add into some other elements as to why. But I think it's not really surprising to me, right? The equal weight is going to be much, much slower moving, but the reaction might have momentum that's very, very different. So it's not surprising to see some of that momentum change in the SPX because the equal weight is drawing it down. How much power the equal weight has on that, now that's the discovery that I still need to do to make a real correlation in this chart, if there is one.
Mm-hmm. Yeah, let's not, we won't go too far down assigning correlation path, right? We don't want to apply correlation where there may not be some. But one thing I will take away from the look of this chart, the comparison between the two, is clearly well-defined uptrends in both, well-defined in long-term periods as well as short-term periods. And so there's been health in this move, Mike, because while in the last week we've continued to trade higher in the S&P 500, it's been largely, according to what we're seeing here, I would suggest largely led by the largest players in the S&P 500, very likely leading into the Mag 7, minus maybe NVIDIA, which has had a little bit of a slower patch, if you will, in the last week plus. But notable chart nonetheless. Let's take a look off the heels of this. We had that jobs number last week, and that rallied. Basically, we used that as a rally point, Mike. The reasoning that I took from it was the increase to the Fed's likelihood, according to traders at least, likelihood of making a 25 basis point cut here in the December meeting. And then you've had a bit of an explosion move with that candle. I'm going to eliminate my measured move, but the candle we had on Friday was just fantastic.
Yeah, and again, the market had expectations, and maybe those expectations are coming to fruition a little sooner. So prices have to rediscover, and we have to find out what that new next equilibrium is. And to your point, that's what that move is. It caught traders by a little bit by surprise. Not that they were not necessarily expecting it, but to your point, those probabilities move out. So now they have to move their risk out because their risk is really based on probabilities. So everything has to price correct in the market, and the market does it very, very quickly, especially in the last few years, at least from my 30-year experience. It's more exponential every day on how fast these prices correct and fall apart, so to say. So to your point, we're at the end of the year. You said it earlier. This is not the time to take additional risk when your portfolio is doing well, just because your portfolio had done well. And that's what I see a lot when I talk to clients. It's they get a little bit more risk on because they feel like they have a little more buying power because they had a good year. This is the time to be risk averse unless it provides an opportunity. So
that's a great point. I loved that. And I also really enjoy hearing this, that perspective from a floor trader, somebody that's been through the ringer more than a few times. You can recognize and share these probability conversations maybe better than most. And I find that that's something our viewers really benefit from. The big reason behind my thought there, Mike, as it related to the shift in expectations, I don't know if you looked at the difference here, but a week ago today, the probability for a 25 basis point hike, according to the CME Fed tool, that third-party application and website that we will reference periodically for you, was about 61% this time last week. After that jobs number, it's now 85%, Mike. So the expectation is slower growth, needing a rate cut, and this rate cut enthusiasm, if you will, might be giving us this boost we've seen over the last couple of days. All right. Mike, go ahead. I'm sure you want to provide a little context there. Feel free.
No. I was just going to say I had nothing to provide additionally. I couldn't agree more.
Perfect. I like the sound of that too.
There you go.
How about our move in the Russell? Small caps today giving us a little leadership. We're up about 0.5%. Now, I think if you look at this from just a standard technical analysis 101, Mike, we have traded through Friday's high. Friday was a doji day. We basically closed where we opened, a bit of indecision after that ugly Thursday candle, but maybe the job number expectation for rate cuts may have pushed the Russell to a new level. If I drew a very tight line through here, Mike, it could be said we've broken the flag portion here, very potentially very early potential aggressive entry for trader interested in the Russell here.
Yeah, and the first thing that it kind of struck my eye was just that, yes, we're in a very good, strong uptrend, especially if you go back even a little bit further. You and I have been talking about the Russell specifically, I think maybe more than most for at least a long period of time now. Point being is, though, you're seeing that even though we're in that really nice pattern, we're starting to see a little bit more volatility within that pattern. The candles are getting a little bit wider, a little bit deeper on the down moves. So which means that it's getting a little bit more volatile, which is interesting because it's historically not a very volatile index. So is the Russell kind of changing a little bit with the way the market's adapting? That's kind of the way I would think of it at first blush. But again, a little bit more discovery on the back end. But to your point here, absolutely, right? We're getting that momentum. So the Russell's going to be the one that's probably scared first, but gets the biggest benefit when things that are very, very positive. And that's kind of my point. You're seeing those kind of big lifts now when it gets a little bit more positivity, because I guess it just needs a little bit more information to feel comfortable moving higher. So that's kind of what I'd be looking for next.
Yeah, I think you're right about that. And if you note where we are in a historical level, we looked at this on the weekly chart. The location of our trade values right now, basically at all-time highs, lets us know that we are at a very important inflection point, Mike. Are we apt to get rejected here? It's certainly possible, right? We don't have to break through. That is not what either of us are suggesting. But one thing we might suggest from the technical analysis viewpoint, Mike, is that when you have a significant level, when it does in fact break, it can be exponential. We don't know if it's going to break, but if it does, the depth of the pattern that we've looked at over the last 4 years or so in small caps, this could be a big move to the upside if it has legs and can push through.
Yeah, I think even to make a little further point in your lane, I will point out, though, I told you you were right. You told me you thought I was right, just for the record. But now, joking around. But I would expect the same thing on the way down, right? So if it does have a little bit of rejection, maybe that first signal you get in the market that maybe this thing is breaking out, like you just drew and said, are we breaking out of that little flag, even though it's very short term? You didn't say we are. You said, are we? Because you need a little more confirmation, or at least that's what you told yourself already. So sometimes we don't hear our own selves in that aspect, right? Point is, though, is that first initial resistance, that retreat might be a little larger too. So just because we see a large retreat doesn't mean we stop looking for what happens next, so to say.
Yeah, and that's a great reminder because look, if this is a spot where we need a pullback, well, the pullback is apt to be kind of deep here. I mean, we're looking at about 150 points on the 2400. 150 Russell points is very different from 150 SPX or NDX points, just based on the values of these indices, of course. So it's important to bear that in mind. But I think that's the clear level, Mike, is that 2275, 2300, very clear support in here. That's the level that likely needs to be maintained. And the only reason that a trader might be a little uncomfortable devoting new money at this point is the potential for rejection at resistance. We don't know if that's going to play out that way, but because risk reward is a little inverted for the bull right here, patience waiting for the breakout might make more sense, even though higher prices may be required to encourage a comfortable buy. That's just part and parcel of technical analysis 101, isn't it, Mike?
That's the unfortunate downside to it, yes.
Yeah. Not that anything we talk about is perfect. We know better than that. We're just talking, as I often like to say, we're all about probabilities and possibilities. We don't say anything has certainty to it. So the probability ratios is really what we're looking for. So, Mike, on the heels of a nice move in the Russell, let's take a look at my friend Lee Bull used to say the skunk at the picnic could be the semiconductors. And really, it's been a while since we've actually referred to them as such. But it's been about, what are we looking at, Mike? Almost a month below, this is about 3.5 weeks or so below what should have been major support. We had the 200-day moving average in blue. We're fighting it out right there. Yes, we're above the 20-day, but we're also sandwiched below the 50-day. So what we're seeing, Mike, is a whole lot of confluence at this range, about 4,900, maybe 5,000 up to 5,100 or so. Really tight range. And Mike, the concern I see from a technical aspect is tied solely to the fact that we broke this triangle and we have not been able to get back into it. This action of 3+ weeks below the trend line that was bullish off of the October bottom is not bullish action in the last 3 weeks.
Yeah, so I mean, from a straightly technical point of view, to your point, right? Like this is something where if you're looking for an opportunity to purchase, the semiconductor index, or at least make a play on the semiconductor index, this is probably not a time where you're happy looking at this chart, right? But is this an opportunity for an investment? Again, so again, it depends on what you're trying to see from this chart and what you're trying to deploy to the marketplace. But from a short-term point of view, I don't know that as a trader I'd be looking into to be purchasing anytime soon here. There's a lot of other headwinds, right? So now you start to think like, why else are the semiconductors having a problem? So it's not just a technical issue. What's the broader issues that you start to dig into? And I think there's enough there. Obviously, the landscape changed again. So seems like something's probably brewing in the semiconductor industry that I probably just don't, I'm unaware of, so to say.
I really like that you put it like that, Mike, because often we have all the story here, right? And it's not to suggest that there's not stories out there that could be evaluated, but just again, from the technical standpoint, something may be happening under the surface that is only shown in price action, that is not yet shown in a more clear fashion through narrative or through headlines, etc. Now, that doesn't mean that we can't put ourselves right back into the trend and be looking bullish very quickly thereafter. But price action in the last 3+ weeks has been significant enough to, if nothing else, maybe force semiconductor owners, long side traders of the equities within that group specifically, just to be a bit more aware, maybe a bit more defensive, maybe raising their stops, doing things that are going to be commensurate with taking a proper disciplined approach to how you want to invest in a given group. Again, we often say it. We don't know what's coming here, but something about this chart is different than it had been. And we could say the same thing really since the peak, Mike. I mean, the explosive move to the upside was wonderful into mid-July, but the conversation around semis has not been as optimistic since then. And the chart pattern is certainly playing into that narrative, isn't it?
Absolutely. But like, if we're looking back and we're looking at this just from a trading point of view, there were opportunities in that down cycle to place trades depending on your time frame. Absolutely. And what your outcome is, right? Are you taking that momentum trade, or are you position trading, from a price point of view? But you see there, right? Every chart always has a bailout or like an early warning signal. So I think you see a lot of early warning signals, to your point, but there's a lot of opportunity to still be a trader inside that pattern, maybe just a little bit more cautious. And I think that's exactly what you're trying to get to.
That's exactly right. And I think that's a great reminder too, that you've had some weakness that did not immediately result in an outright breakdown here in the pattern, right? We broke down from the triangle and we've had to spend time rallying back. And so everyone now is looking at this chart and questioning, are we back where we need to be? Or is this merely the calm before the storm where things might get more negative in the short run? It's tough to know at this point, but if you've been long throughout all of this, you may have been provided a little bit of clues in the last few weeks. I hope I'm wrong about that. I hope this is merely short-term in nature and does not pose a wider threat to us. But we have to look at this. I mean, if we're going to look at the level above which we'd feel better, Mike, it's probably the downtrend line. And that means somewhere in the ballpark of 5,200. We got to get through that to the upside, and things are going to start to look a little bit different. But at least in the short run here, it looks to maintain a defensive posture, perhaps, as some of you are pointing out. Look, and we often say it, there's a bull market somewhere all the time. We just got to find it. That's the trader's responsibility. So it's just been a tough sledding in the semis here of late. All right. So quickly, Mike, let's just look. Well, we're not going to get a whole lot from looking at the fact that looking at the VIX, because the chart doesn't tell us a whole lot, but we still remain under 14. Yeah, the VIX is up 5% today as we meander through the market moves here today. But maybe, Mike, positioning for the week, CPI and PPI this week could easily be a reason for traders just to get a little defensive if they want to maintain long positions into the end of the year.
Yeah, again, defensive, but to what degree, right? Because they're going to want to take risk where they see it, and if they feel like that they get what they want out of it, they're going to have those trades put on too, right? So you might see, to your point, a little bit of a lift or a little bit of consolidation here. Again, we're still at historical highs, so I think sometimes it's worth pointing out historical highs. Well, I have to define that, right? Because if you said that to somebody else, they might be like, "Oh, it was just at historical lows a couple of weeks ago." It was like, right, but for a few periods, short period of time, it was historical for that moment, so to say, is my point. So now we're very, very much at historical lows. The market's making highs. The index is at historical lows. So it's saying there's really nothing currently on the horizon that the market's pricing in that seems overly risky. But you said it on the beginning, right? There's the old saying, things fall apart very slowly and then very quickly. Well, markets kind of exude that on a daily basis, where one change in the floor, can change the dynamics that much. So this is showing you that there's nothing major in the market that's probably going to have effect on the broader. That doesn't mean, to your point, there's not going to be some cracks or some opportunities in maybe some of the subsectors or portions of the market. But historically, I think we're in good shape here from a volatility point of view. So this might be an opportunity to see where volatility is coming from next, because that could be your next opportunity also.
Sure. And I often I like to remind ourselves, look, moves to the upside in volatility are typically short-lived. Those are the instances where we expect reversion to the mean. We're hanging out in the area of the mean, if you will, as it relates to the VIX. And it's the spikes that get you, at least in the last 4 to 5 months, Mike, spikes into the neighborhood of 20, 21, 22. Those have been your opportunities for reversion to the mean. Try not to get bogged down by expectations that the VIX is low, therefore the VIX must rise. Again, it kind of follows the same narrative that the broad market does over the extreme long haul. The market goes higher. Volatility remains generally at a standard level, and when it spikes, we expect it to do so for limited periods, depending on the nature of the negativity or downside we might be witnessing and dealing with. It's the reversion to the mean that becomes much more consistent from a volatility standpoint when you're thinking about the VIX. So we'll see if we get any of that between now and any increase to the VIX here between now and the end of the year. May expect, and I think I've certainly anecdotally heard from analysts suggesting that we may very well see some volatility as we head towards January once we get there. So just something to keep your eye on, everyone. Now, there's been, we should look at oil just because, one, oil is very important for us. But Mike, we maintain that level of support. Look at that $67 ledge, really becoming very well established. It's not the only level of support, but it seems to be one of the more important ones over the last few months. And the tensions in the Middle East are kind of balanced against growth concerns in China right here. And it's kind of held this range for oil, it would seem.
Yeah, and I think, there's not a lot of volatility all of a sudden in oil, because a lot of the things that were creating that volatility are maybe, they're not off the market, so to say, but maybe we have more surety of what the path forward is. So my point with that is, when that happens, especially in a commodity-based trade like this is, you're going to see supply and demand, and that trend should be indicative of supply and demand during periods of time in the market. X the trading adds that extra volatility, or, because otherwise other people in the marketplace are buying and selling their oil as they need to on regular scheduled moments, so to say, in the market in different seasons of the time. That's why we have nice seasonality. So sometimes I think people forget it's not just a trade. There's a commodity behind it that's also driving the market.
Yeah, definitely. It can be easy to forget, right? Because we talk about other things like maybe Bitcoin, for example, and there's not necessarily a physical entity that there's not a real discussion around, something that validates price action more than, it's a risk on comfort right now. And therefore, you're getting the moves you're getting in something like Bitcoin as an example. At least here, we know there is a backing to what's happening in the movement in oil. Mike, what about any specific sectors you're monitoring? I mean, obviously we could move to check energy here, which is bouncing right at the 200-day, but is there anything specific that you've kind of been keeping an eye on here as well that you want to touch on?
Yeah, I mean, it's going to sound terrible, right? But I think every sector, just because they're all so unique and they're changing and they're so dynamic because of the constituents that are in them, we're seeing some moving parts. We can't get probably into it today, right? But there's some moving parts coming to the S&P 500 and even some of the mid cap. So there's always things that are changing in the market. So to assume the sector looks the same, or what's driving the sector today as it was in January, would be kind of pound foolish on my part. So it's one of those things where, you're always consuming the information and seeing what the moving parts that are changing. Even back to that SOX trade, think about a lot of people. Why buy into the entire semiconductor index? I could buy into the S&P 500, get the best of that index, and have some diversification in my portfolio. Whereas the SOX, I'm all in. So what are you trying to accomplish is really what you're trying to be looking for next and trying to maybe not be looking at the noise that's conflicting you in your next trade, so to say.
Yeah, you're right. Each of these 11 domestic sectors have very different approach, and it's why long range investors diversify amongst the 11 sectors of the market. Because when we've been undergoing, for example, looking at that semis chart, remember how difficult it's been looking at semis from July, excuse me, as yields have become more important. We've seen real estate bouncing well, moving favorably. You've seen utilities doing something similar, now in consolidation mode, waiting for the next leg to basically tell us, hey, are we getting new moves to the upside in yields? Are we getting moves to the downside in yields? That's going to have an impact on both of these two, of course. The big move of late has been an explosion in discretionary here, Mike. I talked about this on Friday. The 20-day moving average is way too slow on this. You'd actually have to shift this over to about a 10-day to find any maybe short-term area under which a trader would say, yeah, I'd feel like covering some of my risk if we broke the 10-day. But even here, Mike, the 10-day is like 4% away. I mean, that's 90 points on this $1,900 level. That is not small.
Especially given, the constituents of the index and what consumer discretionary is supposed to mean in the marketplace, right? So I don't know why people felt more comfortable all of a sudden in the last few months of really going out and spending tons of money apparently on things that maybe they didn't need 3-4 weeks prior or didn't feel comfortable buying. So I think, is it the narrative that is driving this, or is it really the companies and the constituents? And I think that's, it's going to be both is the answer. How much is of what, right? So maybe to your point, this move is a little hyperbolical. Maybe it's because of the narrative. Well, maybe there's an opportunity to kind of maybe find when it turns over. Maybe there's an opportunity for you to place a trade there, or vice versa. Maybe there is the undertone of the balance sheets of these companies that are really starting to be better positioned now because of the lower interest rate market. So there's a lot of variables that could be causing this, is my point. We can't just make that assumption looking at it that it's one or the other. But my first assumption is, why is a slow-moving index moving so quickly all of a sudden?
It's got something to do probably with the component breakdown, the leadership, the allocation of funds within the group to one or two notable names, as much as anything else. I did see a quote in here, a comment in here about, I'm not certain this is assigned to us, Mike, but that they like to scare people. I am curious to know if that is about us. Certainly don't feel like we're trying to scare everybody, but what I will say along the way is that we talk trading quite a bit here. That's our approach. And if you're a trader in this market, then a disciplined process to your exit strategy is imperative. You don't want to go about this believing that the market's only going to go higher, because we know that believing in a viewpoint too directly, too definitively is what leads to mistakes. I recognize that many of you traders out there are going to have a higher tolerance for risk than many other viewers here in this class. In particular, I want to encourage you to do what's right for you more than anything else. That's what we're talking about. We're not suggesting that Mike or I know what's coming here. What we are suggesting is that if you are viewing the market in one manner and you believe that this is what's going to occur, great. You've taken one step. Now take the next step, which is, what if I'm wrong? And how will I handle this if this moves against me? What steps am I going to take to mitigate my risk, to mitigate my potential for loss of what I hope to have been profits in a fantastic 2024, Mike? We said it earlier. We cannot appreciate the level of profits we've had this year, and then in the final 2 weeks look to just be reckless in our approach to the market, simply because it feels as though there's a melt up underway. That's what I want to encourage you all to move against. Not that we know what's coming, but rather we don't know. Therefore, it's a great opportunity to be even more disciplined in your process. Mike, I imagine all of that hits a few common notes for you as well.
It hits every single one of them. So yes, every single one of them. Yeah, I mean, it's always that kind of, it's that lens of risk management, right, that you have to have at all periods of time. Because, I had this conversation with a few clients over the weekend at the event. At the end of the day, if you're the one making all the decisions, you're also the single point of your own risk. Yeah. Right. That you can control first.
That's right.
I control my emotions by not acting on them when I trade. right?
Mhm.
And I think that's kind of to the point, right?
Yeah, it's trust me, it is hard. It is hard. Look, if the trader said, "Yeah, this is great. I'll buy it. I'll buy it. I like the breakout, but I don't want to buy in as it's breaking. I'll wait for the throwback." You might be sitting here going, "Well, I've really cost myself opportunity because I didn't participate." And you might use this as a reason the next time to deploy some money to the trade on a potential breakout. I'll talk all the time about the aggressive trader entering on the first break leg because they think that it could run like this. And if you did that with even a portion, you'd be clapping yourself on the back and saying, I did a good job because I took the opportunity to participate. You don't have to go whole trade into everything. We talk about all the time about piecing into those trades as they're moving in your favor. So that was just a nice opportunity for me to bring to the table, again, a discussion on process and discipline, which I speak about quite a bit in many of the classes I host, but it's such a key component for the trader, everybody. All right, Mike, let's get to some stocks in the news. We had quite a few of them today. And some stocks that have been upgraded, some stocks that many of you are familiar with. Mike, let's look at Reddit. Morgan Stanley upgraded Reddit to overweight from equal weight, put a new target. This is a great adjustment, by the way, for Morgan Stanley. Was it $70 a share? New target, $200 a share. The firm thinks it's early in Reddit's platform as it expects engagement and advertising pipelines to drive industry-leading user, time spent, and ad revenue growth for Reddit. So this was a wonderful upgrade, and further, you're getting a continuation on the breakout that was concluded essentially on Friday.
Yeah, the first thing that jumps out to me is that the unbalanced volume, right? I mean, you like to see stocks that are making those types of moves. If you're just from looking at it from a technical point, then know what this company did, right? That'd be the first thing. Big, powerful move, break out of what was beginning to be a very slow moving uptrend, broke out nice. We have this huge move, huge volume. And it kind of proves some of the things you said earlier, too. If you were just looking at the RSI a couple of weeks ago, or a month or so, you probably would have thought the stock had kind of seen its peak. But we see that's not necessarily true. And stocks can continue to extend below because it's a dynamic indicator also. Sometimes I think people forget how dynamic the indicator is.
Yeah, this one is really cruising. The thing that stands out, you called out the on-balance volume, and real briefly, just the math on that, everybody. It is one of the more simple calculations you'll find. It just goes back to day one of the chart you're looking at. In our case, it's a 1-year daily chart, and it's just adding volume on the up days and subtracting volume on the down days. And if I wanted to be a little bit more simple in my viewpoint, Mike, I might just speak to what you called out. Look at the volume in the raw volume bars here when we broke out. That's when volume really kicked in. And that, again, is a reminder you and I are not capable of driving volume like that, are we?
Even as a professional trader, I wasn't capable of driving volume like that. Or if I was, it was only for a moment until somebody else came along with a bigger hand, so to say.
There's always somebody with deeper pockets, right?
Definitely in my world.
Yeah, for sure. So a real nice breakout here. If you've been participating, again, I'll just speak to the need to manage your trade. Are you a seller on strength? Are you a seller on weakness? Consider raising your stop orders if that's been your process. But blue sky above, as you'll see here, I'll kick this to the weekly. As you can see, Mike, there's really nothing you're going to dislike about a chart that looks as aggressively lower left to upper right as you're going to find in Reddit. All right, how about a look at, I had one, Rockwell Automation has been upgraded by KeyBank, and I found this one notable because of the look on the weekly chart. So here's your daily, which is looking like an improving chart, right, Mike? You've had a very nice explosion, but a very deep pullback because, as is common the case, you mentioned this when we were looking at the Russell, where it's a little less common to get it in such a major indice. On an individual equity, you can get big swings like this pretty consistently. But here, we broke the bull flag in the short run right here. But check this out on the weekly. This is where I thought it was a little notable, because the price action since breaking the downtrend here has been really fantastic. And it's been more or less kind of explosive from through 270 up to 300 plus. So it's added a nice 10% just off that pop.
Absolutely. And I mean, look, it's if you're really drawing it too, it's kind of that down channel that it kind of rode, and then you get that big pop. So it's, it has a little bit of a bigger power. Just the pattern itself on the larger side there, right? I mean, because it really did ride that pretty well.
Yeah, an interesting look, and Mike, when we can find these where they occur in daily charts as well as weekly charts, then you're given maybe the opportunity to be looking at what could start as a shorter term trade, and if it goes in your favor quickly enough, it could very well become a longer trade that you can maintain for an extended period of time. The goal always being to stick with our winners, and if you can properly get into one when it's turning a larger corner, so to speak, that can be really opportunity for the trader willing to stick with at least portions of a trade that may be working out.
Yeah, and I like the approach, right? It's always a good approach, regardless of what zoom you're looking at, right? To kind of zoom in and out like you just did from a daily to a weekly to get that longer look at a pattern. I was having this conversation with a client actually over the weekend, and it was the same type of conversation. I said, we just happen to be standing next to the ocean. I'm like, from here, the waves look choppy, right? But when you look out at the horizon, you see very flat. That doesn't mean it's not also choppy out there, right? So you got to zoom in to kind of see with that. But the effect of the waves far out versus far in are going to have different power. And I think that's a really good way to look at charts. And that's really what we're looking at. It is the current, so to say, or the undercurrent of the stock at all given times.
Mm-hmm. Absolutely. Another one that was upgraded today is in the industrial space. Real quickly, I thought we'd just look at industrials, which is retreated, found a potential zone of short-term support. You've had a nice trend working in the industrial space. Many groups, as Mike pointed out earlier, are doing very well. But industrials broke out here in the late summer and has used the 50-day moving average along the way. And now that we peaked back here in a divergent high, from the RSI perspective, at least, we may be approaching a zone of potential support. And this morning, JP Morgan upgraded Cummins CMI to neutral from underweight, new target here at 420, which is up from 355. The firm updated estimates to reflect higher sales growth rates in both their distribution and power system segments, and they see opportunity for Cummins to comfortably exceed their standing 25% EBITDA margin target through 2030. So that actually supplies, from a longer range viewpoint, an opportunity, Mike, for them to continue doing what they've been doing, which is notable because look at this breakout. I mean, what a fantastic technical perspective here after having taken out major zone of resistance in this area. Boy, this thing did one of those standard, hey, we're going to break out and come back and retest it, and then we're getting in gear. And that's exactly what has happened.
Yeah, and I think, a lot of that too is right mapping over the cycle of the economy and where industrials were 3-4 years ago holistically as a sector where money and spending was going. Yeah. So a lot of that money was going to healthcare and technology, and especially in the market. And industrials of the last year have actually, I'm just looking at it as you were saying it, their last 3 years of growth have mostly come recently, as you can see. So it's not surprising to see charts like this. So again, I think it's also a picture of the geopolitical. So they're spending money, right? There's the companies themselves are out there investing and see revenue coming in, but it's a much slower moving industry. So when it hits and things all are moving, you get much bigger momentum, kind of like the business that they're in, right? That momentum eventually hits a gear where you can kind of, use that momentum, and you're seeing that move in the chart now because we're seeing the fruits of the labor, so to say, of the last 3 or 4 years.
And then the last one, Mike, we're going to touch on is very quick. It's on AMD. The AMD got downgraded by Bank of America to neutral from buy. Target here at 155. That's a $25 decrease from 180. We're not going to have time to talk about it any longer than that, but I bring it up, Mike, because it relates to that semi chart we saw earlier, and not every stock in that space looks great. And here is one that has broken that uptrend, same time that the semis did collectively, and we're seeing a continuation to the downside. Mike, I'm going to give you the final 20 seconds here.
Yeah, I was going to say the same thing. As soon as you put it up there, I'm like, man, that looks really familiar, except this looks a little worse. So maybe that's one of the underbellies in the larger sector that you just pointed out. Maybe it's one of.
One of, absolutely. As always, Mike, a fun discussion. I love having you on once a month, getting you here on Mondays. Thank you so much for being here, for sharing your thoughts, sharing your insights with our viewers today.
No, it's absolutely my pleasure.
Love having you, Mike, and love having all of you. Thank you all for joining and participating in the segment. Love hearing from you all. If you have the opportunity, please follow me on X. I'm at Kevin Horner CS. You can also follow Cameron May there at Cameron May CS. We try to post for you periodically. It's a great way for you to engage with us. But if you're catching us in the archives today, you can also use the notes and details down below to post questions. Those come to me directly. I'll be happy to follow up with you that way as well. But appreciate everything you guys do for being here and sharing the class with us. I hope you all have a fantastic Monday, everybody. We look forward to seeing you all again real soon.